We all dream about living off of passive income, and you've probably heard people online talk about real estate, creating courses, starting podcasts, maybe even becoming a YouTuber and starting a channel. All amazing ways to make extra money if you enjoy them, but let's be honest, most of these still require a lot of time, energy, and sacrifice to keep up with. So, what if there was an easier option? An option that could actually allow you to replace your income without taking up a lot of your time. For me, that option has been dividends from investments, and I'm convinced it's one of the most straightforward ways to generate reliable passive income. But before diving in, there's a lot to consider. Dividend investing does come with some trade offs, and it's important to understand both the potential and the limitations. So, in today's video, we'll explore how dividend investing actually works. We'll look at the pros and the cons, and we'll break down exactly how much you'd realistically need invested to live comfortably off of the income it generates. So let's get started with the basics. Okay, imagine this. You are a part owner of a company just by owning its stock. When that company makes a profit, they have a couple of choices. They can reinvest in growing the company or reward the owners. And in publicly traded companies, that means rewarding you, the shareholder, with a dividend. Now, dividends can come in cash through a deposit or a check, or they can be reinvested into more shares of the company. Companies have different schedules for paying out dividends, but many do it every 3 months, like clockwork. So let's talk about dividend yield, which is a simple way to measure how much income you're generating from dividends compared to the stock's price. This yield varies widely among companies and can even change within the same company over time, but typically larger, well-established companies offer higher dividend yields than newer or smaller ones. You can easily look up any stock's dividend yield online, for example on Yahoo Finance, which makes it pretty straightforward to compare different stocks. So for those interested in creating passive income, dividends can be a game changer. It's a way to consistently build wealth without selling shares, meaning the investments remain intact to keep growing and compound. Now, not every company pays a dividend, but for the ones that do, they'll generally range anywhere between 1 to 10%. But as with any investment, there are both pros and cons to consider, so let's dive into what really matters. One of the biggest benefits of dividends is they're often less affected by the ups and downs of the stock market. Over the last few years, we've all seen how chaotic the market can get, right? But dividends tend to stay relatively consistent. This is largely because companies that pay dividends usually have strong cash flows, which allow them to keep paying out profits to shareholders year after year. These companies often have strong financials, making them more resilient and less risky overall. However, it's important to still do your research. Having a high dividend doesn't automatically mean a company is stable, and we'll dive into why that's the case a little bit later. Another benefit is dividends can actually increase even during tough times. If you consider stocks listed on the Dividend Aristocrats list, which is periodically updated from time to time, these are companies that are part of the S&P 500 and have increased their dividends in each of the past 25 years. Companies in this list have been able to grow their dividends through many different economic cycles and through significant periods of recession. So dividends can potentially offer a lot more stability even when the markets are on a roller coaster ride. Dividend-paying stocks also tend to keep up with the broader market. Morningstar and Hartford funds found that dividends have played a significant role in the returns investors have received during the last several decades. Going back to 1960, 85% of the total return of the S&P 500 index is because of the reinvested dividends and the power of compounding. These stocks might not see massive gains in a bull market, but they also don't tank as hard in a crash, offering a smoother ride over time. Next is taxes. Depending on your tax bracket, qualified dividends can also be taxed at a much lower rate than other types of income. For example, if you're single and making under $47,000 or married and making less than $94,000, you might not pay any taxes on that profit. Even if you make more than that, dividends are often taxed at a much lower rate, which can mean big savings compared to regular ordinary income taxes. But there are also a few significant downsides that come with dividends. Even though companies try to avoid cutting or reducing dividends, there are no guarantees and it can definitely still happen. Dividends are usually based on a company's profits. So in a downturn, if earnings significantly drop, a company may choose to hold back those payments until conditions improve. Dividend payments mean nothing when the company itself is declining in value. And let's take Verizon, for example, here. It currently has a 6.5% dividend, but its stock price has lost over 30% in value over the last 5 years. Of course, there's a chance the stock price recovers while you sit back and collect the extra cash flow, but there's also a chance that it may not recover. While dividends have some tax benefits, there can also be some tax disadvantages, like they're taxed as soon as you receive them. Unlike when you buy a stock and sell it, the sale can be timed for tax benefits. Dividends don't offer flexibility here, which could mean paying 20% or more depending on your tax bracket. They can also sometimes be subject to a double tax, once at the corporate level as profit, and again once you receive it. So dividends aren't always the most tax efficient choice. Now let's talk about how much you really need to live off dividends. The amount you need depends on your expenses and overall financial picture. Say you want to live on $6,000 a month or $72,000 per year, and you have a portfolio that's generating 3% in dividends. You'd need around $2.4 million invested. Now, most people would say at this point, I don't have $2.4 million in my portfolio. Am I way behind? And the answer is no. Many people, when they start living off of the dividends from their portfolio, have other income streams like real estate, Social Security, or a pension. So let's look at this more accurately and again assume you need $6,000 a month or $72,000 a year. But before we even look at how much we are going to get in dividends, we need to back out other income sources that you have. So for example, if you have $2,000 in monthly real estate income, well, then you need to replace $4,000. That lowers the required portfolio size from $2.4 million to $1.6 million. If you receive $2,000 a month in Social Security and your spouse also receives $2,000 a month in Social Security, well, now you only need your portfolio to replace $2,000 a month, not the full $6,000. So where do you put your money to get that? Let's look at a few examples. But before we do, understand that none of these are actual recommendations, and I simply chose these to illustrate a point. So let's start by exploring some very real-world examples. Let's start with Franklin Resources, which as of this video pays a 5.95% dividend. That means Franklin Resources is bringing in revenue and income, and they're distributing some of that to you as a shareholder in the form of a dividend. If you need $24,000 per year from dividends, divide that by 0.0595 and you get a portfolio size of about $403,000. So if I had $403,000 in Franklin Resources and this dividend continued, it would make up the difference between what I have coming in from Social Security. That's significantly less than the $2.4 million we discussed earlier. Now let's check out Johnson & Johnson. As of this recording, Johnson & Johnson's dividend is 3.1%. Using the same math, 24,000 divided by 0.031, you'd need just over $774,000 in the stock to get that $24,000 per year and supplement your Social Security, giving you that full $6,000 a month. Now let's look at one more and take Apple. Its dividend is only 0.43% as of this recording, which means you'd need over $5.5 million to make this happen. So we have Franklin Resources, we only need $400,000, but in Apple we need $5.5 million. I show you this to make the point that we shouldn't ever be invested in just one stock. It wouldn't be wise to say, I just want the highest dividend paying stocks, because you might miss out on some great companies, and even though the dividend looks good, the value of that stock could completely plummet and never recover. Take the stock Walgreens Boots Alliance as an example. And again, side note, these are not recommendations. I randomly picked all of these to illustrate a point. But if we look at this stock over a 5-year period, it's down 83%, even though it pays a 10.69% dividend as of the date of this video. So instead of putting all of your money into one or two companies, a dividend-focused ETF can give you a diversified portfolio with a blended yield. The Schwab US Dividend ETF, for example, currently yields 3.47%. If you need $24,000 a year, divide that by 0.0347, and you're looking at needing about $692,000 invested to supplement your Social Security and give you that $6,000 a month. It's a much more manageable approach and gives you exposure to multiple companies that pays dividends. So if you're thinking about living off dividends and generating passive income, diversification will be critical. Don't just focus on one high paying dividend paying stock. Spread your investments to reduce risk and aim for a balanced yield that aligns with your goals so you can have a portfolio that you can live on just the dividends. Thank you so much, everybody. I appreciate you being here. If you enjoyed this breakdown, hit that subscribe button, and I'll see you in the next one.